Alright, welcome back to our second episode of the ICT Building Blocks series. Last time we went over liquidity. We went over what a liquid market is, how it benefits market makers to utilize liquidity to offload their positions, and what to look for when you're looking for your draw on liquidity. Now today we're going to be expanding on that first lesson by going into fair value and fair value gaps. First we learned liquidity and how we were going to draw to it. Today we're going to learn how we're going to utilize institutional reference points inside of the charts that will be referred back to by the market makers in order to drive price towards the liquidity. So what is a fair value gap? Well, if we have fair value in the market, that means that there is an imbalance. Now we have two types of fair value gaps. We have buy side imbalances, sell side inefficiencies, as well as the opposite being sell side imbalance and buy side inefficiencies. Now this is just an overall term for bearish and bullish fair value gaps. Now if we zoom in on the chart here, I can show you exactly what I'm talking about. If we look at this candle right here, we can see exactly what creates a fair value gap. It's simply a 3-candle series with a middle candle not being overlapped by a wick or a body. And you can see that this is this little part right here not being overlapped. So this is now marked out as a green box, and that is going to be our bullish fair value gap. This is categorized as a buy side imbalance, sell side inefficiency. So what does that really mean? So let's just look at what the chart is telling us. We could see that we have a significant amount of buyers coming out of this sell side curve, coming into the buy side curve, and right as we get above all of these opposing imbalances, we leave behind one more imbalance right here. Now, why is this an imbalance? Well, the market has only been offered on one side of the marketplace. Remember, the goal of the market maker is to offer a fair and orderly market. Now, in order to offer a fair market, there has to be an opportunity for both buyers and sellers to enter the market at every given price point. The reason that this is an imbalance is because we can see that there is no selling being taken place. We have a wick here and a wick here. That indicates price moved down and returned back up. Same thing here, meaning buy side and sell side was both offered. When you have a candle in the middle like this where there is no wick, that means only buyers were able to get in there and sell side has not been offered at that price point. Because of that, that is not a fair and orderly market. Therefore, the market makers will retrace price and bring it back to these areas of fair value in order to offer the market to the other side. Once the imbalance has been filled and rebalanced, we can then proceed in the direction that the fair value gap is in. In this case, it is a bullish fair value gap, so we anticipate price to return. Notice the body's closing perfectly in this fair value gap, and then we get expansive moves higher. Now, if you're wondering why I have a box with a line straight through the middle of it, that is because that is called consequent encroachment, or the midpoint of our fair value gap. So these refined levels of the fair value gap, like consequent encroachment, are very useful when you're dropping time frames like we just did. We are now on an hourly chart of that same exact area of price where we saw our daily bullish fair value gap. Now you can see that when price moves through this fair value gap, it returns exactly to that midpoint that we call consequent encroachment to the exact tick before coming down one more time and bursting through our bullish fair value gap. Now, because we're on such a significantly smaller time frame than the daily, this is acceptable to see price go a little bit lower than this fair value gap, because on the daily chart, we are still getting those bodies closed in, and what we want to focus on are the bodies of the candles, not the wicks. Bodies tell the story, wicks do the damage. Alright, and we've dropped time frames one more time down to a 2-minute chart. Now we're going to add 2 more levels, alright? We're going to divide this fair value gap into 4 quarters. Now, I don't use these quarters on anything lower than a daily chart, really. I'm really focused on mainly consequent encroachment for intraday price action, but if you do have daily fair value gaps like this, I would recommend marking out all 4 quarters. Now, the way you would do this is with a Fibonacci retracement, and you can see the settings on the right-hand side of the levels here, just 0, 0.25, 0.5, 0.75, and of course 1. Now that we're on these lower time frames, you can see exactly how price is bouncing between each 4 quarters of this fair value gap. You can see it's propelling price higher at times and propelling price lower at other times. But if it's a bullish fair value gap, why is it propelling price lower? Well, that actually leads us to what's called an inversion fair value gap. So now we're looking at a 15-minute chart from Wednesday, November 29th. Now we can see we have a bullish fair value gap right here on the buy side of the curve. We can see on the sell side of the curve, price is propelled through the bullish fair value gap and eventually returns and propels price lower. You can even see it happening again later on Thursday, November 30th, which is today's trading. Now, when a fair value gap fails, you can anticipate price returning to it and acting as an inversion to send price the other direction. You can see exactly that is what has happened here. Now, dropping into a 1-minute chart, again, you could see the quarters at work. You could see consequent encroachment being respected. You could see the bodies respecting it almost to the exact tick, and we overshoot that upper quarter just by a small amount. And you can actually see this pattern of fair value gaps sending price in the direction the market makers want to take it on this low of a time frame. You could see this bearish fair value gap right here, continually sending price lower. We get one small move into this tiny 1-minute fair value gap right here, respected to the exact tick, and price is sent significantly lower. Now, that's all that we're going to cover on fair value gaps, and it's a very powerful tool to add to your arsenal. Now you know how the market is going to move to and through liquidity by utilizing fair value gaps. Next episode, we're going to introduce order blocks, and pairing fair value gaps and order blocks are going to make for very high probability entries and very high probability exits. There's going to be a lot more to come, so stay tuned. Until then, trade safe. See ya.